Hi, everyone. This is Tim Melvin of MaxWealth.com. Now, I've just got done reading the morning paper with my coffee, and just as almost all the time these days, there was an article in there about the impending real estate crash and how markets were so overheated and it was just so awful, and real estate was too expensive and you should never own it. Which brings me to one unescapable conclusion: you don't own enough real estate. I just finished reading a academic paper that's making its way around the geeky world, of which I am a proud member. And this paper is from the Federal Reserve Board of San Francisco. Yes, the economists at the Fed actually do some really worthwhile research work and not just generate headlines for people to talk about how the world is ending on television. And they looked at the rate of return of everything: stocks, bonds, treasury bills, and real estate since 1870. And guess what the top performing asset class has been? No, not stocks, real estate. Now, and it outperforms rather handily since 1870, and they narrowed it down, and it's outperformed since 1950 and since 1980. But since 1950, something really cool has happened. Yes, the returns have been a lot higher than the overall stock market on a risk adjusted after tax basis. And it's by a substantial margin, by the way. And right up till 1950, real estate and the stock market, they were pretty much, they were correlated to each other. In other words, if stocks went up, real estate went up, and if stocks went down, real estate went down, and vice versa. So investing in real estate was a lot like just owning stocks. But since 1950, stocks have become much more volatile. The world has shrunk. We've become a more global market. There's more political and geopolitical and economic factors that impact the stock market than do the real estate market. Stocks have become much more volatile, and stocks and real estate have uncoupled. And by uncoupled, I mean they're not well correlated. Real estate prices don't really care, for the most part, what stock prices are doing. Now, that wasn't the case in 2008, but that is really the exception. You can't find another period of time where correlations on everything went to zero, at least in my lifetime, and just everything went down. But crash of 1987, REITs had a positive total return this year. They did extremely well. Now let's look at the internet bubble. In 2001, equity REITs that own properties and not just make loans or do other weird stuff with your money, returned 26.3%. In 2002, as the world was really beginning to fall apart, 13.93%. And in 2003, when people were starting to jump off of bridges and out of office windows all over lower Manhattan, they did 3.52% and then recovered the next year by 37.13%, while index investors were still feeling all the pain of the spectacular internet crash that drove even the indexes down by almost 60% from top to bottom. REIT investors just kind of sat there generating cash and smiling and not worrying too much about what's going on in the stock market. Now, in 2008, yeah, it got bad in 2008, 2009. I'm not going to lie. REITs drew down just about as much as the stock market did. It was just as ugly, but they recovered very quickly. The REIT indexes, the equity REIT indexes, were back at all time highs in just 4 years. And if you were brave and bold enough to buy equity REITs when things were just really falling apart, which, by the way, is when we're actually supposed to buy stuff in bad markets, you doubled your money in just about 4 years, doing actually a little bit better in that time frame than the stock market indexes themselves. Now, I talked to some of my friends who are in investment advisors, like, that's just so risky. How can you own all those REITs? You're taking all this risk and you're not diversified. Really? When I look at the REIT sector, I can invest in apartments, I can invest in office buildings, I can invest in timber, hospitals, you name it, and there's probably a sector there for it. And for those of you who are like, oh, I'm just only going to buy the exciting, the growth, the stuff that's going to change the world. Okay, how about cell phone towers? How about data centers? They're going to see a massive increase in demand for those properties as a result of 5G. How about industrial and warehouse properties? Where do you think Amazon, FedEx, and UPS keep all that stuff while it's on its way to you? They've seen an enormous amount of demand. as a result of the move towards e-commerce, and that's just going to continue. Biotechnology, that stuff happens indoors, guys, and uh, life sciences REITs are a major beneficiary as they see increased demand, which leads to higher rents and higher property values. Now, the truth is, I'm not sure why Wall Street doesn't want you to own a lot of REITs. Maybe they don't make a lot of money selling you REITs, and they want to, there's way more stocks to choose from, so it's easier for them to get you to buy stuff. I don't know what the answer is, but I'm going to tell you, you should own REITs for the same reason that Willie Sutton owned banks. That's where the money is. Look at your portfolio, guys. I bet you don't own enough real estate. Now, over at Max Wealth, we talk about real estate all the time because we've gone back and studied and figured out how the big successful real estate investors and the private equity real estate investors buy properties. We buy REITs like they buy properties. We're going to talk about this a lot and other winning strategies at maxwealth.com. So go over and sign up. It's a free e-letter, and I hope to hear from you often. This is Tim Melvin. Have a great